Hi, I'm Karen Erickson.
And I'm Kayla Caruana.
We're from IG Private Wealth Management.
We co-run a mother-daughter practice, and today we're going to talk about investments. Risk tolerance versus risk capacity is extremely important to assess. There is a difference between the two. Risk capacity has to do with the numbers. So what's your age? What is your timeline? How long until you'll need the money? Those metrics are all defined without any feelings. Risk tolerance is more about the feeling. Risk tolerance is about how you perceive risk, how you understand it, and how much risk you truly want to take on.
Because what you don't want to do is bail out on an investment strategy when the markets are low. So if you're in the right risk tolerance, you won't have to worry about that because you'll be comfortable on that ride no matter what port you're in.
And what's important about that is knowing your absolute limit to your risk tolerance. So you might be a high risk capacity person. You've got a long timeline. Take me as an example. I've got a long time horizon until I want to retire. I feel like I understand my investments really well. And then on top of that, I am able to take on a huge amount of risk. But do I want to? That's the risk tolerance aspect.
And then I'm closer to retirement. So, the timeline, I need to make sure that this money lasts till I'm 90 years old. So I have a longer time horizon than you would normally think, because people think, oh, I'm almost retired, so I don't have any time horizon. But that's not true. You need to make this money last till you're both 90. And so I have a longer horizon, but I do feel differently about seeing the values go up and down in such a moderate aggressive way. So over time, we tend to scale it back a bit, going from aggressive to moderate aggressive to moderate and maybe even moderate conservative.
So when we're talking about risk tolerance and risk capacity, once you have those two things assessed, it's important to now incorporate your goals. So like my mom was talking about, when you have a goal of retirement at 60, let's say, and you want to make the money last until 90, you're trying to figure out where you're most comfortable. And once you figure that out, we're able to then create a tax-efficient income plan for your retirement.
And you have to think about, just because you have the risk capacity for taking more risk, do you actually need to take more risk? So the markets go up and the markets go down, and do you need to take more risk to get your goals met? And I think that that's where it comes down to, is what's your goal and what will that look like?
A way to automatically lower your risk in general is just diversification. So creating a well-diversified portfolio, not only geographically, but also sector-wise. Just increasing your diversification will lower your risk.
Everyone wants to talk about investments, and it's about picking the right investment for you. So when you pick the right investment, you also have to think about diversification. When you think about diversification, you have to think about asset allocation. What areas of the world, what kinds of markets, what products are you going to invest in? And you want to make sure that you cover the market as a whole, because nobody can ever chase performance and actually expect to beat it in the future.
Something that we talk about is chasing returns in terms of each sector. Lots of people have concentrated risk either in the US, that's often what we see, or they have concentration risk in a specific sector, like tech as an example. And if you look over a historical period of time, you can tell that yes, those sectors or those geographies have performed in certain years, but they've also been the lowest performer in others. That's why diversification is super important, making sure that you cover all areas geographically and sector-wise.
So when we talk about retirement and we talk about the different forms of income that you're going to have, you might have a work pension, and you also might have some RSPs that you will later convert to RIFs. Those should also be considered to be invested like a pension plan. It really is your own pension plan. Some places don't have work pension plans, so you've got to make your own, and you do that through an RSP. So how do you diversify your RSP as a pension plan? You make sure that you hit the maximum diversification and make sure that you use correlation as a metric for your portfolio. When we talk about investments, people ask, so what's your fee? And the fee is a very important question because it does have an impact on your overall rate of return. But really what you want to ask is the right question. what is the net amount of return after fees that a particular investment is getting? Because you know what, you could go for a hamburger at a fast food place, or you could go for a hamburger at a very nice restaurant, and you will get two completely different experiences. And that's the same for investments.
And oftentimes you are getting the same burger from the same establishment, and you just have different levels of service. And that's also important. So not only understanding fee transparency, understanding where the costs are in your investing, also understanding what level of service that you're being given, and being comfortable with both of those things. If you're paying a large fee, but you're only getting one meeting a year, and you're not getting the tax efficient planning, and you're not getting the estate planning, and all of the other considerations with financial planning, then likely you might be paying too much. And the same is vice versa.
Yeah, it's the value of advice. You know, basically a long time ago, you would pay a lot for each trade that you were doing, and you would get the advice for free. And really that has turned upside down. Now you basically can get trades for very little or free, and then now you're paying for the advice. But I think when you're paying for the advice of a certified financial planner, then you are getting quality advice that just doesn't look at just the investments, but also looks, is this the right investment for you? But is this tax efficient? So it's really important to make sure that you have the right types of investments in the right investment accounts.
Because when you are looking at the tax efficiency of all of your investments and you're planning for your retirement, the most important aspect is each investment inside of that investment vehicle. So maybe it's an RRSP, a registered retirement savings plan, or a TFSA, or a non-registered account. Are each of your investments the appropriate for that account type? And that's one of the most common, I would say, mistakes that we see. There's a difference between retail investing and institution level investing. As a retail investor, you as an individual consumer might have access to certain products, and then at the institution level for the fund managers, they'll have access to way more than what you would have access to as a retail investor.
So when we talk about investing like a pension plan, like Kayla mentioned, institutional investors have a different access to different investments, including private assets and liquid alternatives. And then on the retail side, Canadian equity, fixed income, US equity, international equity, emerging markets, and some even low volatility investments to really make sure that you're prepared for what comes next. And then the icing on the cake is really the active allocation, really making sure we have tactical maneuvers in order to figure out what's going to be coming up next in the markets. As we bring the session to a close, we really want to talk about individual personalization to your plan. Your plan is meant for your retirement and your risk tolerance needs to suit your needs in order to make sure that your retirement plan lasts, because investments are just one component, very important component, but only one component to your retirement plan.
When you're looking at the overall retirement plan, as a CFP professional, we understand to look at every aspect of the balance sheet. You can't make decisions on just your investments and hope for a great plan. You need to be able to have the investments complement the tax plan complement the estate plan, and overall, when you're looking at things like multiple real estate ventures or multiple debt avenues, or you're looking at building your overall income for your retirement, you have to make sure that you're looking at the entire balance sheet. An investment plan is not a financial plan.
That's so true. And basically, in the end, what you want to make sure is that you have the education to make informed decisions. So when you work with a certified financial planner, they will lay out all of the options and how each of them affects every other area of your financial plan to help you and educate you to make really good financial decisions.
It's called holistic financial planning, and it is definitely our specialty.
Yeah, and we're here really to back up our clients to make sure that we give proactive, holistic advice and make sure that it has due diligence involved and that we give good, sound advice.
So if you have just an investment statement or an investment plan and you want a holistic financial plan, please reach out to us. You can visit our website, www.karenandkayla.ca, and book an appointment there for a free second opinion.